Welcome back to Macro Examiner, your go-to channel for in-depth analysis of economic trends and financial markets. In today's video, we'll be diving into the recent announcement from the Federal Reserve regarding interest rates. As many anticipated, the Fed has decided to pause its rate hiking campaign. However, what's interesting is that they've signaled the possibility of rates going even higher. Let's examine the details. The Federal Reserve has left the target for the funds rate unchanged at 5% to 5.25%, aligning with market expectations. This decision comes after 10 consecutive rate hikes, which have steadily increased borrowing costs to levels not seen since September 2007. Furthermore, the Fed has indicated that interest rates may reach 5.6% by the end of the year if the economy and inflation do not show signs of slowing down. This is the first pause in the tightening campaign, and policymakers emphasize that it allows them to gather additional information and assess its implications for monetary policy. While the Fed remains cautious, they have stated that they will be prepared to make adjustments if any risks emerge that could hinder the achievement of their goals. This flexibility demonstrates their commitment to maintaining a delicate balance between economic growth and managing inflationary pressures. Looking at the updated projections, we see that the funds rate is now expected to be 5.6% by the end of this year, up from the 5.1% projected in March. The upward revisions extend to 2024 and 2025 as well, with rates projected to be 4.6% and 3.4%, respectively. It's worth noting that these figures are higher than the previous projections, indicating a more hawkish stance. Shifting our focus to economic growth, the revised GDP projections bring some positive news. The GDP is now expected to rise by 1% this year, surpassing the 0.4% estimate from March. This upward revision suggests a more optimistic outlook for the economy in the near term. However, when it comes to inflation, there's a slight divergence from the March projections. The personal consumption expenditures, PCE. Inflation for this year is now projected to be 3.2%, slightly below the previous estimate of 3.3%. This indicates that the Fed is closely monitoring price pressures, but still expects inflation to remain elevated. These adjustments in interest rate projections, GDP growth, and inflation highlight the Fed's commitment to maintaining stability while adapting to the evolving economic landscape. The balance between stimulating growth and taming inflation remains a delicate task for policymakers. That's all for today's video. If you found this analysis helpful, don't forget to like and subscribe to our channel for more macroeconomic insights. As always, we'll continue to keep you informed about the latest developments in the world of finance and economics. Thanks for watching, and we'll see you in the next video.